This is the biggest thing to happen in self-storage. I'm not kidding. This changes everything, and its impact is huge. And I don't think a lot of people understand how this really affects our industry and these assets. It has started. The new cycle for storage and wealth creation within storage has begun. And we're gonna break it down, and I'm gonna tell you what happened. It's no secret, but it is largely misunderstood. So, what occurred was the Fed. Now, of course, lower interest rates helps everybody. It helps all commercial real estate. But storage is different. And high interest rates over the last 3 years, they hurt. Oh, the pain. Like the pain, everyone. I know all of you that's already in storage that are here listening to me, group therapy here. We'll all pat each other on the back. It's okay. It's been rough, really rough. And it's been rough because the higher interest rates just don't affect the trading of assets or what they're worth. It's not just about refinancing and getting a higher rate that we now have to pay for, and that means that our expenses go up. That's not it. You see, the lifeblood of our business is created from demand from people that need space. Now, other businesses and other asset classes, higher interest rates affected that asset, affects the refinancing. It affects how much CapEx you can put into it. It affects the development cycle, and it can affect customers. But for us, 40+% of our customers are from moving. We have hit the lowest point of housing transactions, even lower than 2008. That's why the last 3 years, we saw rates drop more than they did in 2008, and by a lot. This was a self-storage recession through and through. And it's been painful, not for buying and growing. It's been painful for even operating. And this has been spurred on by the fact that expenses have grown, especially in the South, the Midwest, everybody that's been affected by those insurance rates and costs. It's burned us. So we have lowering demand. We have rates that are dropping due to the fact that dynamic pricing and our large, big friends that are REITs have come in and they just slashed rates by 50% plus in some cases. Why? To attract new people. Why? They tried to maintain high occupancies at the fall of their rate or their offering, because they learned, I can give it to you for $50. Next month, I'm just going to raise it to $150, and the vast majority of you will stay. So that tanks market rates. Occupancy's gone down, rates have gone down, insurance has skyrocketed, and taxes have skyrocketed. Yeah, a lot there. So self-storage, we really got hit on all ends. Our main driver of customer just tanked, plummeted. It just got beat to crap. And that hurt not just for existing, because existing optimized high occupancy, high rents. Okay, well, that takes some time to get out. But all of those that were in fill-up facilities and developments, well, you're now trying to fill up with less demand at a much lower rate. Now, I've had 2 developments that we got out this year. Well, one was technically last year. They're doing great. We're actually really, really pleased with them. Now, market rates, since we put them out, have been really, really hit. But they're filling up fast, and we're already getting those market rates up. The only reason was in those 2 locations, there's been nothing's been developed. These were really hard markets to get to. These were really specialty type facilities. One was a conversion, but it took a long time and costs were much more than we expected. But other facilities that we have were going to be developments or big expansions, including in one of my portfolios where we bought all underperforming and expansion assets. Underperforming means 2 facilities were fill up. Then our other ones were almost new builds. We were completely expanding it. 6 months later, interest rates go sky high. Well, all of a sudden, the entire value add, because that's what I do, on these facilities means you're increasing your expenses, but you are also increasing the cost to acquire, and you are lowering the rate that we're acquiring them. That's on the fill-up facilities. One of the REITs that was in our market, which I won't name names, I don't want to do that. That would be horrible if you named a public company in this podcast, and that public company was slashing their rates by 60% to gain market share and destroying the others in the areas. Now, I heard that other ones are doing it too. I really can't remember though. I think one looked like a cube or something. But anyways, the point being is these companies got super aggressive and just dropped rates like a rock. And in our markets, we had one that was 65% rate cut. $200 rates went to like 60, 50 bucks. This was rough. It was hard. Now, on the flip side, though, we got a lot of benefit, meaning that deals that we have been getting are at massive discounts and great value add. These shifts in storage are huge. They're wildly big. And when you are growing, when you're trying to buy, when you're trying to fill up, you fill it. Now, storage is an incredible product. The fact that we have such great margins and the fact that it's low cost and we have all these things that we can do, try to implement, it does not mean that it's easy, and it doesn't mean that this hasn't been painful. And that's what has shifted. The interest rate outlook. Why the Fed? The Fed announced that they're going to lower interest rates, and it was a big change. They didn't say exactly how much, but it was a shift from tightening to easing. What that means, everybody, the government is not the central bank. The central banks act on their own, and they have two mandates, and that is to control the prices. You know, when you have inflation, that's a problem they work on. And then employment. They want to maximize employment. Now, the inflation got out of control. Goods and services and prices went sky high because there was so much money. COVID and the government just printed like there was no tomorrow, and yet we were all borrowing and spending, and the economy wasn't in a bad place, and they just threw trillions onto it. And like wildfire, it spreaded. Inflation went sky high. Go figure. You'd think they'd learn these things. So we can't control the government. So when this happened, the central bank just jacked interest rates up because they had to get rid of money, get rid of the money supply. Most people don't understand the recessions that we have. The vast majority of them are actually caused by the Fed on purpose. It's what they're literally trying to do. Why? Because if there's too much money and the system gets heated up, you have inflation. So they raise interest rates, which contract the money supply. And by that, you mean GDP, right? Makes things struggle. And then inflation lowers. This time, they waited way too long. They had too much money in the system. And so then when they did it, it was one of the highest rate hikes, the fastest in the shortest amount of time in history, definitely in modern day history. So when you look at that, it was a shock to everybody's system. Main Street suffered. We all did. You have inflation, which is killer. Now, nobody can afford basic things like food. You definitely, shelter is out of control. Housing that was already expensive became wildly unaffordable. But for those that already had a home at 3% mortgage, it actually became like the most affordable it had ever been because they'd already had a home. It was already locked in at 3% and rents kept going up. So all these people that own homes that they locked in at 3%, and a lot of them at a decent price, especially compared to today, it's the most affordable thing they could ever have. So they can't even sell it, or they definitely don't want to. Even if they're moving, they'll move and rent it out. Their mortgage is cheaper than rent. So the housing market froze, just froze. Nothing moving, nothing changing. Even with interest rates for the last 4 years being at what they've been, we still haven't really seen a housing contraction. Yes, we've seen some corrections, like location specific, Austin, some places in Florida, but we have not seen a major housing contraction. In fact, overall, for the most part, over the last 3 years, housing prices have still modestly gone up, which is insane to think about, that you could quadruple rates and housing would still rise. The only reason is because we don't have homes. There's no supply. We haven't been building. We were already short 10 plus million. And now people that own homes, it's so affordable, they can't sell them, or definitely don't want to. That interest rate is almost the asset. So our demand for our industry absolutely tanked. The Fed did that on purpose, obviously, because of inflation. They had to. Inflation running around, the economy would have been destroyed. We would have gone into hyperinflation. They had to do it, but of course, they also were the reason that it happened. Did they wait too long? Yeah, I think so. Why are they doing it now? Are you a new self-storage investor and want to know what that facility is worth, what the risk is, how to underwrite it? Well, that's exactly what we do in a feasibility study. A feasibility study, we actually look at the market for you. We look at the finances, the underwriting, we show you where the upside is, the downside, and all the risk. That is actually what you can provide to banks to get capital and investors. It's a big worksheet, which most banks actually require. So if you want to know what a storage facility is worth that you're looking at, come to us, follow the link in the show notes, and we will tell you. The reason why they're lowering interest rates now has simply to do with one of their core mandates. First, pricing. Inflation got under control. A lot of people will hear that and say, AJ, inflation's not under control. Do you know how much it is to buy groceries? I have 4 children. Trust me. I know how much it is. I shed a tear every time I leave the grocery store. That's not what I'm talking about. I'm talking about inflation, which is the growth of the price. So it's just how fast prices are growing. Inflation coming down doesn't mean prices are coming down. So when you have inflation that's now under control, all we mean is prices aren't soaring. So they were looking for that. They got that. Then tariffs came in, which the Fed was like, oh, that's going to create lots and lots of inflation. Well, as they announced in their last one, it looks like that's not really happening, right? So it looks like we got pretty much all the impact of inflation that we thought we would. So then what have they been waiting for? Full employment. Now, I know you're saying, but that's their goal. Isn't that a good thing? Not really. It's kind of a weird thing. But you see, when you have people that have not defaulted, they're all credit worthy, you have trillions of dollars of capital sitting on the sideline, and everybody's working. If you lower interest rates even a little, then the money supply grows quickly. Remember in 2008 when they dropped interest rates to 0? What happened? Nothing. Why? Because you give somebody money at 0%, it doesn't matter if they can't get it or deploy it. So whether it's 0 or negative or 10%, it doesn't matter because people weren't creditworthy and banks were failing. They couldn't deploy capital. Nobody could get loans. Nobody had cash. So it's not like you could put money down. So all of a sudden you lower interest rates, but nothing happened. Everybody was unemployed. There was nowhere for the money to go and there was no way to distribute it. That is the opposite of today. Banks have huge amounts of cash. Companies have huge amounts of cash. People have not gone bankrupt en masse, so everyone's credit worthy. That means any change in interest rates is felt almost immediately. Let's look at an example. This March and April, our occupancy started to soar. We were like, oh, this spring is going to be great. This is going to be a killer busy season. Immediately after, occupancy's all plateaued. Now, I thought, wait, is this an us thing? We went over and we did over 100 facilities, 130 facilities, not just of ours, of other people's facilities across the whole United States. Exactly the same thing. Why? In March, interest rates went from 6.8 to 6.7. April, they went to 6.5. In May, they jumped back up. And by June, they were back up to 6.8. All it took was like a basis points of 0.8 to 0.7 to 0.6 to make occupancy go boop, 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 pop right up. Housing transactions to go up. We didn't need interest rates to go from 6.8 to 6 or 4 or 5 or anything. It had an immediate effect. As we speak, interest rates are already down because of this announcement. So the Fed, why are they doing this? How are they doing this? Because of the unemployment. The numbers came in this year and the employment looks worse than it originally set out to be. They had to revise it, like 1 million jobs. Now it looks like it may have even dipped negative, which was the first time since 2020 during COVID. But the job numbers aren't good. Unemployment went up and the hiring's way down. So when that occurs, all of a sudden the Fed's like, oh, okay, we are having employment issues, which of course they are. Small businesses, everybody, Main Street, they can't spend. Small businesses can't borrow. Small businesses make up something like 50% of all employment in the United States. You've locked up the capital. Now, up until this point, people had cash, they could still borrow. They were kind of living off it and we were burning through it. There was just so much capital. You just couldn't get it to go down. Now we're seeing employment. This was also caused because of AI. You have efficiencies that have been caused in companies, which made earnings good, but they didn't need to hire as much. Tech companies started to lay off. For the first time ever, we now have college grads are at an above unemployment level than the rest of the population. That's a first. The reason being is knowledge-based value has changed. The main driving reason that was cited by this in the government's report was AI and lack of investment. High interest rates means you don't invest in infrastructure, capital, you're not reinvesting into the company. And now knowledge base that you need to hire, which is super expensive and has high turnover, all of a sudden when I have AI, well, I can have somebody with experience use AI. It's just knowledge base has changed. I'm not going to invest that capital into it. And we're actually replacing a lot of that intermediate knowledge-based jobs. So you have a major key part of society that is starting to fall behind. And employment, people are rethinking hiring. Everybody. Like, well, could we not hire? Is there something else we could do with AI? And we don't have capital to hire. So it's kind of a two-sided thing. This problem with AI was they weren't hiring, but efficiency didn't go down, meaning that they could keep up. This actually led to better results. Why I say that's a problem? I mean, it's not a problem if you're a business owner, but it's a problem if you're the Fed trying to lower interest rates. Why? Because you're being efficient, you're making money. We need actual money supply to contract. We need profits to go down. We need people to go bankrupt. And the bottom line is the Fed rises interest rates to create unemployment. Unemployment means less money in the system, less people buying, lowers demand. Higher interest rates means less loans, less borrowing, less growth, recessions, and not hiring. Once again, this is common. This is what the Fed does. They rise interest rates to slow the economy, stop the economy, and get employment to go down and unemployment to go up. Now that that's started to happen, they've now said, oh, okay, in fact, maybe we're a little late to this party here. Go figure. We can start to shift our course. It was very, very evident. Not only did they flat out state, but they completely changed their long-running goals and monetary policy strategy, reinforcing their maximum employment and price stability, right? But in different ways. Essentially, they eliminated core language and they added in some new ones. So they eliminated referring to averaging 2% inflation over time. Instead, they're going to a flexible inflation targeting mechanism, which means we don't have this target. So we're not waiting for it to get down to this target before we lower interest rates. We're now flexible where inflation may be for us to lower interest rates. They removed wording related to shortfalls in employment and broad-based inclusive employment goals, refining the framework to be more neutral and less pre-committed, meaning that they're opening themselves up. We are now moving towards easing, lowering interest rates, and we're not going to be held back by these targets or specific things, even with employment. They've opened themselves up to move, and also they're not constrained by the guidelines nearly as much in which they have committed to lowering interest rates. What this means for storage. Housing market, housing transactions directly correlate in demand. This is either a long form thing, meaning that if you have lots of occupancy, you can't raise rates like you can because there's just no excess demand. Lots of markets, though, were overbuilt. So they built, less demand meant occupancy went down, rates went down because everybody's fighting over a smaller amount. This fills up that supply. Therefore, stabilizing occupancy in those markets, allowing us to raise rates. It is a complete shift in the overall cycle, both occupancy, rates, demand that we are moving into. But it's combined on the back of development cycle that is really basically shut down and shut off. These things are what we've been looking for. Development cycle is long-term demand. Interest rates are more immediate and short-term demand. Over the next few years, we now can see an outlined course, or as I like to put it, the wave of higher demand in self-storage. Lower interest rates creates higher values in our assets. It allows us to deploy capital, to expand. It allows us to build. It allows us to be more robust in our investment thesis and strategy and to gain those returns in many different ways, both on the building, the buying, the selling, but also on the revenue management, on the marketing, and on the business operations sides of this asset class. I am very excited, everyone, about this change because it was killing us. It was killing the storage industry. It was killing everybody. And we were finding great deals. We bought more this year than we have in the past. Once again, as I mentioned before, we are personally investing millions. I am personally. My partners are personally, alongside our investors, as we just keep buying. The next 6 to 12 months, we hope that as interest rates slowly come down, these opportunities will keep coming out. We are seeing the most opportunities in things like CO deals and others that have been struggling, where we're getting better discounts on that have good runways. This isn't a light switch. It doesn't just flip and change overnight. Once again, because the market is so sensitive to lowering interest rates, this will take time, but we will already see this change. The housing market, we don't need it to boom. We just need it to not be frozen. Minimal transactions will make a huge change in our industry. The housing market to just have a heartbeat will make a huge change in our industry. Next spring, we'll probably see the greatest effects of it. Interest rates have already come down on the market. As the Fed starts to lower, that should continue. Then as the moving season begins, we will hopefully continue to see strong demand. What we look out for and what we need to worry about is that these actions actually lead to inflation, that the job numbers, hiring picks right back up, and we go to full employment, have some inflation, and the Fed has to reverse courses. That would not be good. We are off balanced in the economy. There's way too much money. Main Street is suffering. They don't have access to capital, and the cost of everything is way too high. We need the equilibrium to come back to the middle so we have more of a normalcy. The idea of stagflation is the biggest worry in this case. That's the biggest relief when we saw employment. Not we, I mean the Fed and the United States. That's why when you had bad job numbers, the market jumped like 200 points, the stock market. And you think, why are they celebrating if we have bad economic news? We have bad economic news because finally interest rates being that high are actually taking effect. That's the problem. Other than that, the economy's great. The economy's growing. Interest rates are this high and the economy's actually growing. It doesn't mean that it's good. It's lopsided growth. And people are still suffering. They don't have access, housing increases, everything else. But we're at an interest rates that's hands down the highest that we've seen in 2 generations. And the economy didn't crash. It didn't free fall. Not only did it not, it hasn't for years. The economy is very resilient right now. So lowering interest rates will have a big, big effect. And for self-storage, it's going to be game changing. I'm excited about this, everybody. If you want to see more data, learn more, make sure you guys sign up for our newsletter. And until next time, we'll keep you guys updated coming up and keep you guys updated with transactions, what we're seeing, how interest rates unfolding or being lowered, even market interest rates, which have dropped down today. There's about a 2-month lag in the data and the numbers. I'll be reporting and I'll be showing that to you guys. And so we can look, even in the slow season, it is my guess that already what's happened in the last 2 weeks, we're going to see occupancy change, demand change, which will set us up nicely for spring, therefore boosting our returns, our revenue numbers, and creating a pathway for storage to get back to normal. Guys, could you comment, like, subscribe to stuff? I mean, that is the currency of all these platforms. iTunes on Apple, right? Leave me a review. That is my currency here. It really does help me. Like, that's how you guys can repay us for being open, sharing, and communicating with you guys, the industry. So give a review, like, comment, subscribe, do all that stuff that all the cool young kids tell you to do at the end of YouTube videos or whatever. It is the currency on here. It helps me out. Appreciate all you guys. Talk soon.